Hey Bowtie Nation, Joseph Hogue here with a kind of hard truth for investors. Stock analysis is hard. Well, to do it right anyway. You can always just blindly follow the trained monkeys here on YouTube into a stock. If you don't mind, they probably pulled it out of their ass with no analysis either. But to invest the right way, the way that is actually going to make you money in better stocks, it is harder than just chasing some 20-year-old into a stock pick. But we can make it easier, and that's what I'm going to do today. Show you a way to compare stocks that is a quick yes-no answer to the stocks you should buy. I'll highlight the 9 most important financial ratios I used as an equity analyst, show you a step-by-step on how to find them, and then how to compare them against the most popular names, Nvidia versus AMD, CrowdStrike Holdings versus Palo Alto Networks, and then Meta Platforms versus Alphabet. Now here, I do feel a little like a hypocrite because when I started investing in 1999, I wasn't looking at the financial ratios. I wasn't doing the hard work. Hell, nobody was. We weren't looking further than the price chart and which stock was going to make us rich overnight. Turns out, that wasn't a great strategy. I learned my lesson the hard way, that it is the financial ratios I'll show you that will not just tell you which stocks to buy, but also when to get out before the bubble pops. That's because these financial ratios are like the vital signs to a company's financial health. Just like a doctor checks your pulse, your blood pressure, and temperature to get an overall idea of health, investors use these ratios to measure profitability, management efficiency, and debt to simplify the financial statements and be able to compare stocks side by side. Instead of spending days drowning in pages of an annual report, ratios give you the quick signals you need to decide if you want to look further. And that simplicity is the biggest advantage here. You don't need 1,000+ hours studying the material in the Chartered Financial Analyst designation like I did. Anyone can find these ratios within minutes and get an instant snapshot and comparison for which stocks to buy right now. But it ain't all rainbows and unicorns either. Some of the downsides you'll see are the false sense of security from these quick tools. The numbers look good, but you still need to dig deeper to understand what the ratios say about a company. Ratios are great for that quick filter for which stocks to buy, that first pass to save you from wasting your time or losing your money, but should always be used with a bottom-up stock analysis process like I showed you in our last video. Let's get started on these 10 financial ratios every investor needs to know. I'm going to be using these to compare 6 stocks in 3 industries, showing you how to find the best stocks to buy. I'll start off with my favorite long-term growth theme, cybersecurity, with shares of Palo Alto Networks versus CrowdStrike Holdings. Starting off, the market cap here isn't a ratio, but just the total value of all shares in the company. We won't use it much here, but it's going to be critical in our next video on stock valuations, comparing these stocks to get the best deal on price. Here we see that Palo Alto is a $128 billion company. And next here, the big 3 profitability ratios. These show how well management is doing converting sales into levels of profit and can be a great clue into where a company's competitive advantages lie. Gross margin is how much is left after paying production costs and suppliers, so it can tell you if a company has a better brand and pricing power over suppliers or customers. Here you take the gross profit and divide by total revenue. That's about $6.7 billion gross profit for Palo Alto, divided by $9.2 billion in sales for a gross margin of 73%. And those of you out there in the nation know the operating margin is probably my favorite single ratio for analyzing a stock. After a company removes its production and other costs in the income statement, next it deducts operating expenses like staffing, marketing, and sales with the operating income left over. So here, the operating margin or profitability is telling you how well management is doing controlling those business costs to convert sales into profits. For Palo Alto, we take the $1.2 billion in operating income divided by that $9.2 billion in total revenue for a 13.5% operating margin. Honestly, I don't spend much time here on the net margin, which is the bottom line earnings divided by those total sales. All this is really telling you beyond that operating margin is how interest on debt and taxes are affecting their profitability, and I'm much more concerned with how well management is doing with that operating margin. So here we can take the $1.1 billion in net income divided by that $9.2 billion in sales to see Palo Alto's 12% net margin. You'll hear investors talk about the return on equity, or ROE, more than almost any other return metric. It's easy to calculate, but I do like the profitability margins better. Here you're taking that net income, so the profits of the company divided by the average of the last 2 years' equity from the balance sheet. Basically, the ROE is telling you how well is management using investors' shareholder equity position to create profits. From the balance sheet, we use this year's $7.8 billion in equity, plus last year's $5.1 billion to get an average of $6.5 billion in shareholder equity over that period. Then we take the $1.1 billion in profits generated by that $6.5 billion to see that Palo Alto produced a return of 17% on its shareholder equity in the business. These next two ratios on solvency aren't as important for these large, well-funded companies, but are critical for value stocks or smaller companies. That is because debt can kill a company faster than anything. So anytime you're trying to catch a stock on the way down, you better know the solvency ratios and what that says about the company's survivability. For the debt-to-equity ratio, we're going to go here to the balance sheet and find the amount of non-current or long-term debt. Some analysts like to use total debt here, but I like using this long-term debt because it's a better measure of the leveraging strategy the company is using. These current liabilities or short-term debt are being paid within a year, so not as good a long-term indicator. So here we'll take the company's $7.7 billion in non-current liabilities and divide by a total equity of $7.8 billion for a debt-to-equity ratio of 99%. But understand here, that in itself does not tell you anything. It's in the comparison with other companies like we'll do here, and then in comparing the number with Palo Alto's own history of the ratio, that's where you're going to find out if this is dangerously high or a smart leverage decision by management. Interest coverage is just how many times the company can cover its interest expense each year with the operating earnings. Can it cover that debt expense easily with profits, or is it just over its head in debt? Here you look into the net interest line on the income statement and then find the interest expense, which is the amount the company is paying on its debt. We'll take this operating income here of $1.2 billion divided by that interest expense of just $1.9 million to see Palo Alto has no problem making its interest payments, covering interest expense by 650 times. These liquidity ratios are two more that are extremely important anytime you're analyzing companies with shaky financials or in a tough business environment. The current ratio measures how well the company can cover its short-term, one-year obligations. We take the current assets here on the balance sheet, which are those assets that can be converted to cash quickly, like inventory, receivables, and then that actual cash. Then we compare that to the debts and the payments the company has due over the next year in these current liabilities. Here we see Palo Alto has $7.5 billion in current assets, but $7.9 billion in current liabilities, so a current ratio of 0.94 times. Going further here, and if the company were really in trouble and we wanted to see how much just its ready cash would do to pay the bills, we would take this $2.9 billion in balance sheet cash against the $7.9 billion in current liabilities for that cash ratio of 0.36 times. And finally, before I show you the comparisons here and how to put these to work to picking your stocks, these two cash flow ratios aren't really two ratios, but a way to see how much management might be fudging the numbers. That's because, nation, there are 1,000,001 ways to make net income or earnings look better on the income statement, accounting shenanigans that are completely legal but can come back to bite a company in the ass later. Things like delaying expenses can boost profits and make management look brilliant in a current quarter, but we're going to deflate profits to come and cause a nasty surprise for investors. The cash flow statement, though, showing actual cash in and out of the business is harder to fudge, so comparing a company's growth in its operating cash flow versus what it's reporting as earnings growth in that income statement can help you see any red flags before they become red in your portfolio. Here on the cash flow statement, the operating cash flow is actual cash in and out of the company, raw cash generation without the accounting tricks. I like to get a trending rate rather than just 1 year, so we're going to take this $3.7 billion last year divided by the $2.7 billion 2 years before, and then annualize that to see Palo Alto has grown its operating cash flow at a 16% pace. Then using the same 2 years with the net income on the income statement, dividing last year's $1.1 billion by the $439 million 2 years ago, annualizing that, we see the company has reported a 60% pace in earnings growth. So for me, definitely something I would want to check into. What accounting gimmicks is management pulling to grow its earnings so much faster than actual cash flow? Here I've filled in the rest of the ratios for the other companies so we can compare each of these together. Palo Alto and CrowdStrike are getting to be about the same size and have a comparable gross margins, but it's in the operating profitability where we really start to see the differences. This is where you would want to look deeper into the financials to explain this difference. Here, CrowdStrike and many of the other cybersecurity companies are spending more heavily on research and development, along with marketing to grab as much market share as they can in this growing theme. Palo Alto has chosen higher profitability at the expense of a little growth, though it's still growing sales at a respectable 14% pace. And we see that difference carry down into the net margin and the return on equity metric, so Palo Alto is clearly more profitable than CrowdStrike. On these solvency ratios, since CrowdStrike posts negative operating income, we can't get an interest coverage ratio, but we do see that it is less highly leveraged than Palo Alto, with just 57% debt to equity, where Palo Alto has almost 100% debt to its equity ratio. That level of leverage almost certainly isn't a problem for Palo Alto, though, because it is growing sales and is so profitable that there is clearly no problem covering its interest payments. These liquidity ratios tell us something similar, that CrowdStrike is more conservative in its use of debt and has better balance sheet health. CrowdStrike can cover its current liabilities easily with just the cash, while Palo Alto only has about a third of its one-year liabilities covered in cash. This is just a decision by CrowdStrike's management to hold a little more cash and current assets to cover its near-term bills, since it is a little riskier business model with that negative earnings, while that higher profitability means that Palo Alto can hold less cash and still be fine. But it is here in the earnings quality that I would really want to watch. CrowdStrike's negative earnings means we can't calculate a growth rate there, but this operational cash flow looks good, and the negative earnings are because it's investing so heavily back into the business with R&D and marketing. But then it's here, this difference between the income growth and the cash flow for Palo Alto is a warning sign and is a big part of why I like CrowdStrike here as the better stock. Now I'm going to walk you through how shares of Meta Platforms stack up against Google parent Alphabet next, and how one is a clear winner in this internet media space, but there are 3 critical ways you need to be using these ratios. First is in the kind of head-to-head matchups like we're doing here, or even better, comparing all the stocks within an industry like we did in our bottom-up stock picking video. In that video, we used a few of our financial ratios to compare across the discount retailers to see that Dollar General wasn't worth its expensive valuation, Target has some major competitive problems, and that Walmart and Costco have clear competitive advantages in the space. And within that is a crucially important rule that you're comparing these ratios across companies in the same industry. Adding Nvidia to the list here tells you nothing other than how much better it is to be a chip maker rather than in consumer retail. Growth rates and margins can be so wildly different between industries that mixing your stocks like this isn't going to tell you which is truly the best of breed in their own industry. That idea of within industry comparison is going to be even more important when we look at valuing a stock in our next video, how to tell when a stock is just too expensive or a great deal. Here we see shares of Dollar General look like a steal at just 2.7 times on a price to sales basis compared to Nvidia. This says you can buy an ownership stake in DG for just $2.70 on every dollar of revenue generated by the company, less than a tenth the price of valuation you'd pay on Nvidia. But then if you compare that stock within its industry, you see it's actually very expensive compared to these other retailers. Another important way to use these is to follow a company's own ratios through time to spot any trends in its performance. Here we can see that while Palo Alto's gross profitability has stayed consistent, management has done an amazing job at improving its operating profitability through those cost controls. Management's work over the last 3 years has made PANW the most profitable cybersecurity company in the industry. It's also improved the solvency and liquidity ratios, paying down debt and lowering the debt-to-equity ratio. So it's looking at the company this way over time that tells us that even though Palo Alto records slower revenue growth than some of its peers like CrowdStrike, management is on the ball here and deserves another look. Tracking these ratios across an industry and across stocks over time can also help save your money from the next crash. If I had known what the hell I was doing back in 1999, I would have seen a market where financial ratios had lost all sense of reality. Profitability ratios were deeply negative. Companies were piling on debt and hiding behind a cash hemorrhage through shady accounting. Nation, I know this is a lot of work, but if you are not doing this analysis, this top-down or bottom-up process that I showed you in our previous video, following some of these ratios in this video, you are not investing but gambling, and you might as well just go to Vegas, where at least you get the free drinks. Back to our analysis, though, and the Meta versus Alphabet mashup. Here we see Meta easily the more profitable company in every measure, and using investor equity to generate higher returns. Alphabet uses lower leverage, though, has a better debt-to-equity ratio, and is able to cover its interest payments, though it doesn't mean as much to these companies as it might for smaller or maybe value stocks. Even on that higher debt-to-equity ratio, Meta will have no problem financing its operations or paying down debt. Here, both of the companies look good with the consistent cash flow versus income growth. Now, I do like the higher growth on Meta, but the consistency between income and cash flow growth for Alphabet shows real quality earnings there as well. Now, as helpful as these ratios are, understand they're just a piece of the puzzle, measures you can use within your stock picking process to narrow down to the best stocks to buy. They won't tell you everything you need to know alone, but are critical to finding the best breed stocks to watch, and more importantly, the red flags in stocks that are going to lose your money. It wasn't until I started digging into the material in the Chartered Financial Analyst designation, the CFA, that I understood these ratios aren't just busy work, that is the lens into each company's story. There is a story hidden behind these numbers that, if you learn how to read it, you will never have to worry about your stocks again. It tells you why Meta is so much more profitable than Alphabet. It can show you why Palo Alto is growing net income so much faster than actual cash flow, and if it's a red light flashing on the dashboard just before the car bursts into flames. Now I'm going to show you the numbers behind Nvidia versus AMD next, the story of a 1,200% return over the last 5 years. But make sure you watch the rest of the videos in our stock picking series within the playlist here in the corner. It is a complete course on finding the best stocks to buy, and it is completely free. Even though Nvidia and AMD are in the same industry of chip makers, looking at the financials shows you how these companies are miles apart and gives you a clue into why Nvidia has dominated the conversation for AI semiconductors. Here, looking at the profitability, we already see Nvidia's pricing power over suppliers and customers in its gross margin. Chips so good, customers will pay any price. I think the drop from gross to operating profitability here for AMD says more about management's inability to control costs than as a comparison with Nvidia. We know both companies invest heavily in R&D, but why are AMD's other expenses so much higher that its profitability here is a problem? And I had to double check Nvidia's return on equity here because it's unheard of for a company to produce a 141% ROE, but shows you just how this company has become the stock to own over the last few years. While Nvidia has a higher debt-to-equity ratio, its other solvency and liquidity ratios look better, and neither company is so heavily indebted that it's a problem. Here in the earnings quality ratios, though, this difference in cash flow growth reported by AMD compared to its net income growth, it does worry me a little. Higher income growth versus cash flow doesn't necessarily mean management is playing fast and loose with the accounting tricks to grow that net income number, but it's still a red flag. Net income cannot grow faster than cash flow forever and could be a harsh wake-up for investors when it does reverse. Nation, ratio analysis isn't just which company is better. It is a story between two companies and their industry. It is your clue into why one company is more profitable, why one company deserves a higher price, and which one is going to be your better investment. I know investing can feel like gambling, but even if ratios won't guarantee you get rich, it is the time you spend right here that is going to put the odds in your favor. Check out the video on the right for the next in our series and learn in 20 minutes what it took me a decade to learn on Wall Street. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.